China's real estate market, once a powerhouse of economic growth, is now facing a severe crisis that's shaking the foundations of the world's second-largest economy. For years, property development in China was a key driver of the nation's GDP, providing homes, jobs, and wealth for millions. But the boom has led to a dangerous bubble, and now that bubble has burst. Developers are defaulting, unfinished homes dot the landscape, and millions of ordinary citizens are feeling the pressure. So, what went wrong? And how does this massive crisis impact not just China, but the global economy and your personal finances? To understand China's real estate crisis, let's go back to where it all started. Over the last 30 years, China experienced unprecedented urbanization. Cities expanded rapidly, and millions of people moved from rural areas to urban centers. To meet the soaring demand for housing, developers went on a building spree. Elites looking to build wealth. Property prices surged, and soon owning multiple homes became a common investment strategy. However, developers financed these massive projects with huge amounts of debt. They borrowed heavily, expecting the housing market to keep growing indefinitely. But as more properties flooded the market, supply began to exceed demand. With prices rising faster than people's incomes, affordability became a serious issue, and fewer people could afford to buy homes. The warning signs were clear: unsustainable debt levels, slowing home sales, and a growing number of unfinished construction projects. By 2021, the cracks in the system became too big to ignore. The collapse of Evergrande, one of China's largest real estate developers, was the tipping point. Evergrande, drowning in $300 billion of debt, failed to pay its creditors, leaving thousands of projects unfinished and millions of homebuyers in limbo. This triggered a domino effect across the industry. Developers that relied on high leverage were unable to meet their obligations, construction halted on many projects, and property prices began to plummet. The crisis spread from the housing market to other parts of the economy, sparking concerns about the broader financial system. Local governments, which depend heavily on land sales to developers for revenue, were also hit hard. With developers pulling back, government budgets suffered, and public services, infrastructure projects, and even wages for civil servants came under threat. China's real estate sector isn't just a small part of the economy, it's massive. Real estate accounts for nearly 30% of the country's GDP. That means any trouble in the housing market has far-reaching consequences. First, let's talk about local governments. Chinese cities rely heavily on land sales to developers to fund their budgets. When developers stop buying land because they're either broke or too scared to take on more projects, local governments lose a key source of revenue. This means fewer funds for infrastructure projects, social programs, and even basic public services like healthcare and education. Second, the banking system is feeling the strain. Chinese banks have significant exposure to real estate, both through loans to developers and mortgages to homeowners. With developers defaulting on loans and buyers refusing to pay mortgages on unfinished homes, the risk of a banking crisis is growing. Third, the crisis has created a significant drag on consumer confidence. Many Chinese households poured their life savings into real estate, and now they're seeing the value of their homes drop. Some buyers who purchased homes off-plan are stuck paying mortgages on properties that may never be completed. This creates a vicious cycle. As people lose faith in the market, demand for new homes falls even further, exacerbating the crisis. China's real estate crisis isn't just a domestic problem, it has global implications. China's massive demand for construction materials like steel, cement, and copper has driven prices and fueled industries worldwide. As construction grinds to a halt, demand for these materials is plummeting, hurting exporters around the globe. Then, there's the issue of China's interconnectedness with global financial markets. International investors, pension funds, and banks have exposure to Chinese real estate companies. Evergrande's default, for example, sent shockwaves through global markets, wiping out billions of dollars in investments. A prolonged slowdown in China's economy could drag down growth in other major economies, especially those that rely heavily on exports to China, like Australia and Germany. So what does all of this mean for your personal finances? Whether you live in China or not, the lessons from this crisis are universal. First, diversification is key. Many Chinese households bet heavily on real estate as their main form of investment, and they're now paying the price for putting all their eggs in one basket. This is a reminder that it's important to spread your investments across different asset classes. Real estate, stocks, bonds, and even alternative investments like gold or cryptocurrency. A balanced portfolio can protect you from downturns in any one sector. Second, this crisis shows the importance of liquidity. Real estate is an illiquid asset. It's hard to sell quickly in a crisis without taking a loss. This is why having some liquid assets, like cash or easily tradable stocks, is important for financial stability. Lastly, emergency funds matter. With the uncertainty in China's housing market, many homeowners are facing financial difficulties. Having an emergency fund can help cover unexpected expenses, whether it's a job loss, an economic downturn, or a property market collapse. So where does China go from here? The Chinese government has been stepping in, trying to stabilize the market. They've introduced policies to rein in developer debt, imposed stricter regulations on borrowing, and provided some stimulus to revive the property market. But this is a tough balancing act. On one hand, the government wants to avoid a complete collapse of the housing market, which would have devastating consequences for the economy. On the other hand, they need to prevent the same reckless borrowing and overbuilding that caused this crisis in the first place. In the short term, we can expect more government intervention, possibly in the form of bailouts for struggling developers or incentives for buyers to return to the market. But in the long term, China will need to find a way to reduce its dependence on real estate for economic growth. This might involve shifting towards other industries like technology, manufacturing, and services. China's real estate crisis is a cautionary tale about the dangers of unchecked growth and excessive debt. For individuals, it's a reminder to stay diversified, maintain liquidity, and always be prepared for financial uncertainty. The global economy is deeply interconnected, and what happens in China will have ripple effects across the world. So whether you're an investor, a homeowner, or just someone interested in personal finance, this is a crisis worth paying attention to. Let us know your thoughts in the comments, and don't forget to like, share, and subscribe for more insights into the world of finance.